All right, here we go. Good evening, everybody. Looks like we got a strong showing. That's always exciting. Good to see everybody this evening. Welcome to the Hurley Investments market commentary of April 18th. Yep, a couple of you know the drill. Type something in so I know you're hearing me. Thanks, Jim. Abraham, good to see you. Thanks, Bill. All right. Well, man, I've got like a million articles. We'll kind of go over a few of them with as much time as we can. But first up, just got all of our earnings laid out for us. And some of them, obviously, we're still waiting for. But some of them we can talk about right now. Mainly Bank of America. We had JP Morgan report on the 13th. Couple others. USB is not a big one for us that I care to talk about too much. So Bank of America numbers were earnings of 80 cents per share versus 75 cents. Let's forget the period before expected. So they beat on earnings. Their revenue came in slightly better than expected as well. 23.33 billion. Ooh, I like how I capitalized that I in there. I should just capitalize the whole thing. Billion. Versus 23.2. So just barely on the revenue, but it's a beat is a beat. And I thought there was an interesting take on it in this video this morning. Let me see if I can't have you guys watch along with me and see if I can't get you to hear this. So audio might be a little delayed for you, but you'll get the point. Just real quick, can you guys hear that? Someone tell me, make sure that's coming through for you. No, dang it. Let's see. Let's see. Well, that foils my plans. Okay then. So basically, I'll let you read what this goes in. Beat on income. Oops. Talked about that already. Just need to find where it talks a little bit more. Okay, so this. So she's reporting that earnings would have been 8% higher if it hadn't been for taxes and other provisions, which is a huge deal because obviously we got tax season, and not every season is tax season. To have that 8% is a huge deal. Deposit and loan growth were up. Interest rates, net interest income was up 13%, which is a huge one. Just bear with me while I'm trying to find out some key points here. So card loss was half the rate it was a year ago, which is great. All right, so she goes on about how equity trading is up record levels and not necessarily fixed income. So some huge positives, especially that one of net interest income for banks up at 13, for Bank of America, excuse me, up at 13%. So those are huge numbers. So just looking at a chart, this was our chart today for Bank of America. Of course, it had come down for a couple days because of basically what happened to JP Morgan, who had a $500 million, or was it 500 billion? I can't remember. I think it was $500 million cost that that we'll get into in a little bit, see if we have time for that. But long story short, not a recurring problem that JP Morgan, or of course, and certainly not the rest of the banks need to worry about. So Bank of America had great earnings today. They beat, obviously, as I mentioned, and a huge jump today. So what did we do? We took our protection off. We had protection up at 39 a few days ago, and before earnings, we decided to roll down that protection from 39 down to 38. If my memory is correct, it might have been 40, 39 or 40. So we booked about $1 of profit rolling those down, and we had 38 strike puts for earnings, and we're able to take those off earlier today for a negligible loss. So the difference there is pretty good. And of course, we had this longer trend that we had made up. So really nice. I'm really happy with where we're at for Bank of America and what we've been able to do for the last couple weeks. Huge support, up 4% today and bouncing, and I really like what we're seeing there. And because of that, a lot of the other banks started to reverse. People started to realize, hey, JP Morgan really shouldn't have gotten caught up in too much negative headlines, and it took another bounce up on support level there today as well. So we took protection off of JP Morgan as well and had a lot more profit there in the puts for JP Morgan shares. So those were some things today that I really liked, and things that we were able to do. Moving on to the big picture. I really like these briefing big picture articles. You can get them yourself if you want. We just like to link them here because they just give a good overview of the latest in our economics. Talks about whether or not we've peaked on our inflation. If you remember our last inflation report, let's see, for I guess the March, yeah, so it talks about it here, March Consumer Price Index and Producer Price Index was incredibly high. But you might have noticed when those reported, trying to remember what day that was, it might have been one of these days. You see these big white candles. Everything went up. And it was kind of ridiculous. Of course, it reversed and kind of this downtrend that we're at, but you would have thought that we would have continued to go down pretty quickly from that. But for some reason, investors are thinking that because this is so high right now, that we've probably peaked on our inflation. So just to go over some of these points briefly, CPI was up 8.5% year over year, and CPI was up 6.5% year over year. PPI was up 11.2% year over year, and core PPI was up 9.2% year over year. Those aren't the Everest-like peaks seen in the 1970s and 80s. Nevertheless, the current inflation readings are at treacherous altitudes that haven't been visited in the case of CPI since the early 1980s. We can't say for certain whether we're at peak inflation, with Russia continuing to wage its war on Ukraine and China continuing to wage its war on COVID with a zero tolerance approach. So obviously two big problems, Ukraine, Russia, and of course China thinking they can fight this Omicron variant that obviously they can't. And those are the two problems that continue to give us long-term worry, especially for consumers, right? Continuing on, what we can say, however, is that the market should be careful about cheering peak inflation, because cheering peak inflation is also unwittingly cheering for a peak in the recovery. And then they talk about a pivot in inflation. And this is a part that I really thought was interesting. To be fair, supply constraints have played a huge role in driving the outside inflation prints. Yet there are other factors on the demand side that have contributed to the worst inflation readings in 40 years. That would be roughly 10 trillion combined of fiscal and monetary stimulus that led to huge increases in the money supply, huge upticks in personal savings, and huge increases in asset prices that were catalyzed by the artificial suppression of interest rates driven by quantitative easing. So to put that in plain English, our government, because so much money had either been given out personally to people, a lot of you probably saw your COVID stimulus checks, as well as the Fed printing money and buying fixed income assets to push money, flood the market with, and the economy with money, with cash. All that did, and I'll have to add here because they didn't necessarily add it, when you pay people to stay at home and not go to work, even if a lot of people did work from home, certainly a lot of people stayed home and got released from a job and didn't go back to work, at least for a while, right? Right now, obviously, we are at very low employment, very low unemployment. So most people are employed, right? But that's one factor they didn't really add in, because for the while there, we all were sitting at home and the economy stopped. So you combine that with the flood of cash into the market. So huge increases in asset prices, such as homes, cars, new cars especially, that we're still dealing with, catalyzed by the artificial suppression of interest rates by quantitative easing, which was the Fed lowering interest rates to zero, making money so easy to borrow. And basically, the Fed is behind the 8 ball because our inflation is going up quick and they're just barely getting to the raising interest rates to try and tighten up money supply, or money that's out there in the market in the economy. Moving on, fiscal support outside of the infrastructure bill is fading fast. Monetary support is being pulled, but arguably not nearly fast enough. A growing number of Fed officials, though, seem to recognize that we have been paying a lot of lip service to the idea that the Fed needs to move rapidly to the neutral rate and beyond for some hawks, and take a more aggressive approach to reducing the size of the balance sheet than the Fed did during the previous recovery. So basically, everybody's recognizing that the Fed is behind the 8 ball. They need to, in order to remedy that, they need to catch up with raising interest rates quicker than they did in the previous recovery from post-2008 financial crisis. This understanding, combined with a base comparison math, strengthening dollar, predilections that supply chain problems will keep moving, and ironically, the demand destruction that results from the high inflation is the basis for thinking inflation readings will start to fade from the March peaks. So translation there is, because strengthening dollar and supply chain problems being remedied in the near term, people are using these as the basis for why they feel that inflation has peaked. It would be, moving on here, it would be a welcome sight if in fact they did. but it may be just short-lived feeling of relief given some of the emergent activity in the stock market that is more consistent with an outlook for much slower economic growth. So then they go over some of these pictures of shots of these charts. A picture's worth 1,000 words. Here we represent a few pictures for consideration that are out of sync with a strong economic outlook. Specifically, we're looking at the Dow Jones Transportation Average, Philadelphia Semiconductor Index, and SPDR Regional Banking ETF, and the iShares US Home Construction ETF, none of which are trending of late in a manner consistent with feel-good attitudes about the economic outlook. So basically they're saying investors or even consumers are kind of, because of some of these charts that you can see are on the downtrend. It really doesn't make sense to think that we've necessarily had a peak or that the economy will continue to settle and reverse and continue higher. So they're arguing we want to see the trend lines on these charts moving up. That would be construed as a sign of confidence in the economic outlook that translate into stronger earnings growth. Current trend lines are suggesting the opposite, even though the market is presumably embracing the idea that peak inflation has been hit. This is the case and most likely because the connection is also being made that the Fed is intent now on using rate hikes and quantitative tightening to cure inflation. That will translate into higher market rates that will first curtail borrowing activity and consumption on the margin before having a broader influence. So basically that will make it harder for companies to borrow. It won't necessarily, it might help curb inflation a little bit, but it also might have the problem of creating a economic downturn as companies are less willing to invest and borrow because interest rates are higher. And this is basically what they say here. From an objective standpoint, the March CPI and PPI reports were downright bad. There was nothing to cheer here except maybe if you're thinking of buying a used car. Still, when things are as bad as those inflation reports suggested, the market likes to think things can't get any worse. That could be true here, but with the warlike effort in Ukraine getting bogged down and the reported logistic supply chain problems in China stemming from lockdowns to stop the spread of COVID, there's no guarantee things are going to get significantly better soon. The Fed, however, now sees a target on the back of inflation. That's the only way it can see it because the Fed has been running behind inflation for far too long. It will now be playing catch up with aggressive policy normalization efforts. As it does, the inflation rate is apt to take a step down, but so will the economy. That's the knock-on effect of rising interest rates, which are necessary to get inflation under control. Cheering peak inflation then is tantamount to cheering the arrival of slower economic growth and slower earnings growth that should translate into lower earnings multiples. So, you know, I agree with a lot of what he's saying, or Yes, Patrick O'Hare. Except for this. Do we really think that the Fed has so much control over inflation? Is it really necessary? Is it really going to help that much to raise interest rates? Certainly it would help a bit, but I still don't have anyone that can tell me or help me understand how the Fed raising interest rates solves the problem of high oil prices and gas prices, which is a huge contributor to inflation because there's a huge knock-on effect to pretty much every industry. Not so much social media companies or whatnot, Facebook, tech companies to some degree. But Apple has to ship computers, and that costs money with gas, and they've got to get parts to make those computers, and that costs fuel as well. So you need a factory that uses power to produce those chips and construct those computers and those phones, etc., etc. So I guess my point is, with the fact that these two problems he's listing here, Ukraine getting bogged down, war effort in Ukraine, and the supply chain problems with China's lockdowns. My feeling is that raising interest rates are not going to have the real impact that the Fed might pretend that it might have. So I've kind of been talking. I'd like to get an idea for what you guys think. How do you guys think, as a consumer or as an investor, what is your outlook on your optimism for the economy? I don't need a big explanation, but do you think, in simple terms, our economy is going to be strong, continue to go up? Or are you worried that some of these problems we're dealing with are going to cause it to go down? What is your optimism level? And you can just say optimistic or pessimistic or neutral. Go ahead and put something in. Just kind of want to get an idea. Abraham says some parts will grow, some parts will go down. World is adjusting to new way of living with debt and greed. So you're taking, Abraham, the neutral part where some things are going to kind of offset other things that are going down. Russ says neutral. Okay, so we got a couple neutrals. The rest of you, don't be shy. This isn't a right or wrong answer. you think I know the answer. I really don't know better than you. Okay, so Abraham says, no, I mean that we'll need to be more selective on what we do. Okay. Jim says, pessimistic due to current leadership. After elections, may be in a better position to be positive. All right. That's an important point, Jim. I feel like that is the general consensus of what a lot of people feel. Bill says, too many black swans swimming to be optimistic. I can definitely understand that. So something that I feel and to kind of piggyback off what you said, Jim, we have a very, and I'll bold that, very unpopular president right now. I think I saw, excuse me, I saw his approval rating at like 30% or somewhere about, which is one of the lowest I've ever seen. It is no bueno for Mr. Joe Biden. But because he's wildly unpopular and because the Democrats really have nobody else, they're going to have to be politically expedient in dealing with the inflation issue. So I'll say for Democrats, they're probably going to look at, let's see, how would I say this? They're probably going to have to take a backpedaling approach and we'll need to do something about inflation. Read gas prices if they want any chance of a holding offices in midterm elections that are coming up at the end of this year. And of course, a couple more years we'll have the presidential election again. And like it or not, how people feel about the president definitely affects how the party he's a part of strategizes for midterm elections and Congress and all of that. So what does this mean? Well, I don't know yet, but I feel like if they want to do this, they're going to have to, or I'll say they may have to, open up domestic oil drilling to make gas cheaper. Why have they not done this? They keep blaming it on Putin, and they keep blaming it on this and that, and the oil companies can drill whenever they want. They say a bunch of stuff. The reality is if you make it harder to get the drilling contracts, if you put a bunch of red tape around things, if your whole environmental position is dependent on people changing their mind about gas guzzling cars and switching to electric cars, you know, that's going to have some conflict of interest problems. Poor people and really anybody that, you know, middle class is going to have a hard time putting up with that. You can't push people into buying electric cars that are much more expensive, that aren't as efficient, that don't get the mileage that gas cars do, that have any number of other problems that just don't work. But number one, it's just not there yet. The infrastructure isn't there yet. And, you know, you're pricing out poor people. Okay, let's see. Yes, Jim, they haven't shown expediency this far. They like higher gas, you know, like it or not, they like the higher gas prices because they think that it's going to push people into buying electric vehicles, and they're trying to change the dynamic and take power away from the oil companies. It's the same thing that Obama did, but now they're just using every excuse with COVID and the war in Ukraine as blame for not doing anything domestically to help solve the problem, because they want people. They think this climate change is the worst problem that we face, and we need to get people to solve that problem. We need to get people into electric cars, get away from the gas guzzlers. But again, my main point is it's just not ready for it, and this really puts a huge strain on lower income homes. So if they do this to try and curb some of the inflation comes down, they might be able to hold a few more seats in Congress, because people just aren't buying the whole blaming of Putin and all of that. Certainly that contributed it, but if you look at a chart, and it's not very hard to find, if you look at a chart on inflation, just as soon as the turn of the year after President Biden takes office, he signs a bunch of orders, making it much more difficult to drill, shuts down the Keystone Pipeline, which wasn't up and going, but it's the flow of oil that the market expected that now isn't going to be there. All of these things caused inflation to go up. That doesn't account for continuing to throw money at people. But nobody's going to complain about the government giving them money. So this is really the bigger deal. So my thought is possibly that if this happens, we will have a little more optimistic on the inflation front. Not necessarily that it's going to change the world, but something to keep in mind that might change things enough that will get people to vote a couple more Democrats in. So moving on, where will we end this week? I'm saying lower, just because it's where we're at. Get my picture here. The S&P. I know I need to change from bullish to bearish. Aside from the banks, I don't know that we're going to have a bunch of great earnings on further out on the market. Kind of feeling like that's how other investors and people are viewing things as well. But obviously this is kind of what is forefront in people's minds. Oops, I didn't want to do that. There we go. Take a picture of our Dow. Our NASDAQ composite. All right. Oh, goodness. Okay, got our charts up. I'm gonna go bearish on the Dow. It is holding that 50-day, but any earnings that we don't like, on our Dow is going to change that pretty quickly. S&P already is below the 50-day. And so is the NASDAQ. Doesn't mean that we can't have our stocks be outliers. I'm really interested in how Disney is going to go. Stopping at a little support on a pivot point here. I'm really interested in how Facebook is going to go. More on that in a minute. Right now I've got April ending at 0%. That's just if we kind of come back to median from this drop. Plenty of earnings coming up. That was today. Halliburton tomorrow. Johnson & Johnson, IBM, Netflix. LMT. I know what LMT is. Why can't I think of it? Goodness. Brain fart. Someone help me remember the name. Lockheed Martin. Thank you. Goodness gracious. 10 points for both of you, Bill and Jim. You guys probably have Lockheed Martin. I don't have anybody with it. So that's a Kevin one. Couple others. Key Corp. That's one I'd like to look at Thursday that I'm interested in. Regional Bank. I'd love to compare that with Bank of America. Bill says change it to cash and I'll take it. Sounds like you have to have a conversation with Kevin, Bill. NEM. Interesting to see how the mining gold companies might be doing. All right. Economic reports, NHB housing market index, building permits, existing home sales. So we got a lot on our housing market that's important this week. I'm going to skip how am I looking to trade. Obviously, we're protected for earnings. Not much to say there. Pretty interesting article. This guy basically saying that this was a former Moscow correspondent for, I think, MSNBC. I could be wrong. I'm checking the article, but his thought is basically that there's really only thing that Putin is interested in is the energy, oil they've got through Ukraine. They have two pipelines, I guess, that one goes through Belarus, the other goes through Ukraine and gets around 2 billion a year in transit fees from Ukraine. And so he's been all of the big talk and the whole reason he's invading Ukraine is because of this. And why he's been so volatile of any hint of Ukraine joining NATO, because this is what supplies them with most of their country's money, and it's where Europe gets most of their natural gas energy. So that one's a good one. I liked this one specifically more because of Facebook. He says, let's see if we can get back down to where he talks about. Where did he talk about it? let's see. Give me a second, bear with me. Talks about how they got stung because they had big holdings in Netflix and Meta. Here we go. Meta Platforms, this is Facebook. After being hurt by Apple's privacy policies, the whole reason you see this chart over here that dropped from 330 all the way down to 240 and downward, bottoming at 185-ish, is now valued as if Facebook isn't growing at all. That is a pretty big, important point. Meta made a crap load of money on their last earnings, and they're still projected to make tens of billions and billions and billions of dollars into the future. And his point, after being hurt by those privacy policies, Facebook is at a price level as if it's valued as if it's not growing at all. Do you think that Facebook isn't going to grow? Question over to you guys. If you say no, then I'm really not sure what to tell you. They spent a bunch of money on investing into their metaverse. They're aggressively investing to get it up and running sooner than later. I see that as a confidence in what they're investing in rather than a negative. So they said to boost exposure to Meta platforms, the firm sold put options. It says when other investors believe our companies are substantially riskier than we do, options prices will be higher than our estimate of their intrinsic value. When opportunities like this surface, we'll sell puts or calls, an alternative to purchasing or selling shares. So basically, they like to hold on to the shares and just sell calls to make some money up on the way down, or sell puts at lower price levels, probably, which gives them a chance to buy more shares at lower prices. They can put money to work. So I thought that was interesting. Go ahead and read that one. This one on Goldman, talking about how recession risks are too early. They talk about the 10 and the 2-year note, which has been one of the things that the market and the economists look at. If the bond rate of the 2-year note goes higher than the rate of the 10-year note, it's a sign of a recession coming up. They say correctly that recessions have, on the yield curve inversion, has been on average after 20 months. So it lags about 20 months. If you guys remember, we've talked about this. Some of you new people won't know, but we've talked about this back in 2018 when we had a big February 2018, a big crash by the algorithmic trading because of this 2 and 10 yield curve inversion. It's happened a couple times since then, and we still haven't gone into a recession. So 20 months is probably even much shorter than in reality we're talking about here. So good one to read though. 3 must-own stocks: Apple, Microsoft, and Alphabet. And this JP Morgan article tells a little bit more about the and it was a $500 million hit. not billion. That would be much worse. But it explains that a little more in depth. I'll let you go over that because we're kind of at the end of our time for tonight. But before we go, is there any last thoughts or questions that I can try and help answer? It just says, what other sector besides energy is rising? Well, right now, it's probably going to be banks, but you can see this one's going down. Here's our tech going down. It pretty much is energy, IDA. Crap. Trying to remember the Pfizer. Just going to look up health ticker. There we go. Pfizer's kind of flat. Maybe those have run their course. Yeah, that's pretty much it. What we're looking for, I would rather be looking for what is going to take off next rather than what has been trending up so far. No, Ida, we're not in a bear market technically yet. As you can see the chart here, this is kind of where we peaked end of year. You know, we've had our dips, come down, had some corrections. I don't even think these were considered in correction territory, which I think is what 10. This would have been 10%, I guess, from high. It's been as low as 13 or 14%, but obviously we're higher than that now. So no, we're not technically in a bear market. Guys, any other thoughts, questions? I can see some people filtering out, so I will assume we're probably getting to the end here. All right, guys, that does it for you. That does it for me. Thanks for joining me this evening. I'll get this posted and get those articles out to you so you can read through some. A lot of interesting stuff to go over. Thanks, Jim. Thanks everybody. Thanks, Ida. Thanks, Abraham. I will see you guys next time. Take care.